Welcome to the deep dive. Today, we're digging into a pretty substantial document. It outlines a whole host of proposed tax changes affecting, well, pretty much everyone, individuals, families, businesses.
That's right. And our goal here isn't to drown you in legalese or, every single tiny detail.
No, definitely not. Think of this as us giving you the highlights, the key takeaways from this potential legislation. We want to give you a clear sense of what might be on the horizon and how it could, impact your wallet or your business.
Exactly. We're looking at a proposal, potential legislation, and our job is just to pull out the parts that seem most significant, the things you'll likely want to keep an eye on.
Okay, let's jump right in. The document kicks off with a section called Tax Relief for American Families and Workers. First up, no tax on tips. Sounds appealing, right? But how does it actually work?
Yeah, it does sound good. The way they're proposing to do it is interesting. It's a new deduction, an above-the-line deduction.
Above the line, so that means it reduces your adjusted gross income,
Yeah.
right? Before you even think about standard or itemized deductions.
Precisely. For qualified tips, in those jobs where tipping is common. So it's not just ignoring the income, it's a formal process to lower your taxable income right off the bat. Could be a real benefit for folks in service industries.
Hmm, interesting mechanism. You wonder if that changes how tips get reported, or maybe incentivizes more reporting.
It could, yeah. Or how employers handle it. Something to watch.
Okay, next one. No tax on overtime. Another one that probably makes a lot of ears perk up. What's the important detail here?
Again, it's proposed as an above-the-line deduction for qualified overtime pay, but the key thing, the sort of check on it, is that the overtime has to be properly reported on your W-2 form.
Oh, okay. So it has to be official documented overtime pay that your employer reports, not just, staying laid off the books.
Right. Needs to be formal, which again raises questions about employer payroll systems and making sure everything lines up correctly.
Makes sense. All right, let's talk about seniors. There's an enhanced deduction for seniors. What's the proposed?
This looks like a boost to the standard deduction specifically for older taxpayers, probably aimed at age 65 and up, though the text just mentions over a certain age.
Yeah, and how much of a boost are we talking?
The proposal suggests an extra $2,000 for single filers and $4,000 for joint filers, on top of whatever the regular standard deduction is at the time.
Okay, so that could be a decent bit of extra relief,
Yeah,
especially for retirees on fixed incomes.
definitely. It directly increases their non-taxable income. Of course, you then think about the overall cost and how it fits into, the bigger picture of retirement funding.
True. Now, this next one, no tax on car loan interest, feels like it could impact a lot of people. What are the specifics?
It's quite specific, actually. This proposed deduction is for interest on qualified passenger vehicle loans. Key things. The loan has to be taken out after December 31st, 2024.
Okay, so only for new loans starting next year.
Right. And it has to be for a personal use vehicle secured by a first lien on that vehicle.
First lien. So not like a home equity loan you happen to use for a car.
Exactly. And it also excludes a bunch of other things. Fleet sales, for instance. Personal cash loans where you use a car you already own as collateral.
Okay.
Commercial vehicles, lease financing, cars with salvage titles, vehicles bought just to resell. None of those qualify. It's really aimed at the standard consumer car loan for personal driving.
Got it. And what kind of vehicles count? Is it just cars?
No, it's broader. It covers cars, minivans, vans, SUVs, pickup trucks, even motorcycles. Also includes ATVs, certain trailers, campers, things designed for temporary living, whether motorized or towable.
Wow, quite a range. Any other big requirement?
Yes, a significant one. The vehicle's final assembly must have happened in the United States.
Ah, so there's a made in the USA angle built right in.
Seems like it, a potential nudge towards domestically assembled vehicles.
Okay, so U.S. assembled personal use vehicle financed with a first loan after 2024 might get an interest deduction. Is there anything else tied to this?
Yeah.
Like reporting?
Yes, there's a new reporting requirement for the lenders. Banks or finance companies receiving this qualified interest would have to report a fair bit of info to the IRS.
Such as?
Borrower's name, taxpayer ID, the amount of interest received, outstanding principal, loan date, and even vehicle details, year, make, model.
Okay, so the IRS would get the data to cross-reference claims. That makes sense.
Yeah, helps with verification.
All right, that covers the first section on relief for families and workers. Let's shift to expanding tax benefits. What's being proposed here?
A lot of this section seems focused on making some existing but temporary benefits permanent. First up are ABLE accounts.
Right, those savings accounts for individuals with disabilities.
Exactly. Two things here. First, making permanent the rule that allows contributions to an ABLE account to qualify the beneficiary for the saver's credit. Second, making client the ability to roll over funds from a 529 college savings plan into an ABLE account tax-free.
And both of those were set to expire.
Yeah, end of 2025. So this would provide long-term certainty for families using these accounts. It makes you wonder why they were temporary to begin with, what the thinking was there.
Good point.
Yeah.
Stability seems pretty crucial for those kinds of plans. What else is getting extended or expanded?
There's a focus on hazardous duty pay recognition. The proposal would permanently add the Sinai Peninsula to the list of qualified hazardous duty areas for tax purposes. Its current designation was also set to expire after 2025.
Okay.
And it would also permanently add Kenya, Mali, Burkina Faso, and Chad to that list. So, ongoing tax acknowledgement for personnel serving in these challenging locations.
A nod to the risks involved. What about student loans?
They're proposing to permanently extend the rule that excludes student loan amounts from gross income if the loan is discharged because of the borrower's death or total and permanent disability.
That seems like important relief in very difficult situations.
It really does. There's a new requirement mentioned you need to provide a social security number to claim the exclusion, likely just for verification.
Standard procedure, probably. Okay, anything else under expanding benefits?
One more, a bit more niche perhaps. It's the creation of a qualified business development company interest dividend, or BDC interest dividend.
Okay, BDCs, those invest in smaller or developing companies, right?
Generally, yes. This proposal would create a special category of dividend paid by these BDCs, specifically linked to the interest income they earn from their qualified business activities. It would start for tax years ending after December 31st, 2025.
And the potential effect. Maybe encourage more investment in BDCs?
That could be the aim. By giving preferential tax treatment to some of their distributions, it might make them more attractive, potentially channeling more capital towards the types of businesses they support. Could have knock-on effects for growth, maybe?
Interesting. Okay, let's move to the next section. Investing in the health of rural America and Main Street. What's the focus here?
It seems pretty targeted. The main item mentioned under this heading is about rural emergency hospitals. The proposal is to expand the definition under Medicare. This could allow certain hospitals in rural areas that had previously closed to reopen under this specific designation.
So potentially bringing back some healthcare access to underserved rural communities.
That seems to be the goal, recognizing the specific challenges rural healthcare faces and trying to adapt the system a bit.
Could be a big deal for those areas. All right, now we get to a section with a, shall we say, very specific title. Make America Win Again, Working Families Over Elites.
Yes, quite pointed. And interestingly, it starts by briefly mentioning the no tax on tips and overtime proposals again.
Kind of reinforcing who those are aimed at.
Exactly, highlighting them as measures for working families.
Okay, so besides that reminder, what new proposals fall under this banner?
There are several business tax items. One big one is about research and experimental, or R&D expenditures.
R&D, right? What's the change?
The proposal is to allow businesses to immediately deduct their domestic R&D costs for tax years, starting after 2024, but before January 1st, 2030.
Immediately deduct. So not amortizing them over several years like the current rule for post-2021 expenses.
Correct. A temporary return, it seems, to immediate expensing, but specifically for domestic R&D. The document hints that foreign R&D might get different treatment later, suggesting a push to keep research activities within the U.S.
That could definitely incentivize companies to spend on R&D here, at least in the short term. What else for businesses?
There's also a temporary change proposed for the business interest deduction limitation for that same 2025-2029 window.
Okay, the limit on how much interest expense a business can deduct, how would it change?
The proposal is to calculate the adjusted taxable income figure used in that limit without subtracting deductions for depreciation, amortization, or depletion, basically using an EBITDA-like figure as the base.
EBITDA. Earnings before interest, taxes, depreciation, and amortization. So a higher base income figure.
Generally, yes, especially for companies with significant assets that they depreciate or deplete. A higher base means the interest deduction limit would be higher, allowing them potentially to deduct more interest expense during those years.
Interesting tweak. Could help capital-intensive industries. Now, opportunity zones, OZs. There's talk of a second round.
Yes, this is quite detailed. The proposal outlines a plan for a second round of qualified opportunity zone designations starting January 1st, 2027 and running through the end of 2033.
But with changes from the first round.
Significant changes, it seems. They're proposing a narrower definition of a low-income community eligible for designation, focusing on areas with higher poverty or lower incomes.
More targeted.
And a big emphasis on rural areas. At least one-third, 33% of the new OZ designations must be in census tracts defined as rural.
Okay, a clear rural focus.
Also, tracts that are merely contiguous to a qualifying low-income tract wouldn't be eligible on their own anymore, unlike in the first round. Seems like they want the investment directly in the neediest areas.
Got it. And what about these Rural Qualified Opportunity Funds, or RQOF?
This is a new thing aimed specifically at boosting investment in those designated rural OZs. They're proposing enhanced benefits for investing through an RQOF compared to a regular QOF.
Enhanced how?
The basis step-up incentive. If you hold an investment in a regular QOF for 5 years, you currently get a 10% increase in your basis. For an RQOF investment held 5 years, the proposal is for a 30% basis step-up.
Wow, 3 times the incentive for the rural zones.
Exactly. A much stronger pull. Plus, there's a proposal allowing individuals to invest up to $10,000 of post-tax ordinary income into either a QOF or RQOF.
Okay. Any other rural advantages?
Yes, the substantial improvement test for existing properties. In rural OZs, the threshold for improving a property would be lowered, needing to invest only 50% of the building's basis instead of the usual 100%. That could make redeveloping existing structures more feasible.
Easier to fix up older buildings in rural OZs. Makes sense. Reporting requirements.
Yes, new information reporting is proposed for both QOFs and RQOFs. They need to provide details about their investors, the investments they make, and significantly the impact on employment within the zone. More transparency on what's actually happening.
Trying to track the real impact. Okay, still in this working families over elites section, what about lending in rural areas?
There's a proposal related to interest on loans secured by rural or agricultural real property.
Okay.
It suggests that qualified lenders, generally banks and financial institutions with a U.S. presence, could exclude 25% of the interest they receive on qualified rural or ag real estate loans from their gross income.
So a tax break for banks making these kinds of loans.
Essentially, yes. It applies to loans made after the law is enacted and before January 1st, 2029. There's an exclusion for loans made to certain foreign entities. The idea seems to be encouraging lending for farms and rural properties.
Could help lower borrowing costs indirectly, maybe?
Potentially, or just make lenders more willing to lend in those sectors.
Gotcha. What about housing?
A small tweak to the Low-Income Housing Tax Credit, or LIHTC. It proposes adding Indian area to the definition of difficult development areas.
Which means?
Projects in those areas could qualify for enhanced tax credits, making it more financially viable to build affordable housing in tribal areas.
Addressing a specific need there. Okay, shifting slightly to employer support. Childcare.
Yes, proposed amendments to the credit for employer-provided childcare. The changes would allow employers to claim the credit even if they contract with a third party for the childcare services, or if they partner with other employers to run a joint facility.
More flexibility for businesses wanting to offer that benefit.
Seems like it, making it easier to participate.
And paid family and medical leave.
Okay.
Any changes to that credit?
A couple of things. One, it clarifies that to qualify for the credit related to an employee's leave, the employee generally needs to be customarily employed for at least 20 hours per week.
Setting a threshold.
Right. And second, it prevents a double benefit. Employers wouldn't be able to take a deduction for the wage expenses equal to the amount of the paid leave credit they claim.
Makes sense, avoiding double dipping.
Yeah. And it also mentions directing the Small Business Administration and the IRS to do more outreach so employers actually know about this credit.
Good idea. Okay, now here's something new. Credit for contributions to scholarship granting organizations. Tell me about this one.
This proposes a brand new federal tax credit for individuals or businesses who donate to qualified scholarship granting organizations, or SGOs.
SGOs. These give scholarships for K-12 education.
Exactly. Elementary and secondary school scholarships. The credit amount would be limited based on the donor's adjusted gross income, and there'd be an overall national cap on the total credits available each year, allocated among states.
So, a limited pot of credits. What makes an SGO qualified?
Several requirements. They'd need to provide scholarships to multiple students attending various schools, not just one. They'd have to prioritize scholarships for certain students, likely based on income or need. And they'd face information reporting requirements. Rules for jointly run SGOs are also mentioned.
Seems like a way to encourage private funding for school choice options via tax incentives.
That appears to be the structure, yes.
All right, let's talk 529 plans again. Qualified higher education expenses. What's changing?
This looks like a potentially huge expansion of what you can use 529 account funds for, tax-free.
Beyond just college.
Way beyond. The proposal would add expenses for elementary and secondary school, public, private, or religious to the list of qualified expenses.
Wow, what kind of K-12 expenses?
Things like tuition, fees, curriculum materials, books, online resources, tutoring, educational classes outside the home, standardized test fees, even certain educational therapies for students with disabilities.
That's broad.
And it explicitly includes expenses related to homeschooling that fit these categories as well.
So 529s could become much more versatile savings vehicles for education from kindergarten all the way through college.
That's what it looks like, yeah, a major shift if enacted.
Okay, now for another one with a very distinct name. MAGA accounts. What in the world are these?
MAGA accounts, standing for Make America Great Again accounts, are proposed as a new type of tax-exempt savings account.
Tax exempt like a Roth IRA.
The description suggests contributions might not be deductible, but the growth and qualified distributions would be tax-free. So yes, similar in principle to a Roth.
Okay, what are the rules? Contribution limits.
The proposed annual contribution limit is $5,000 per beneficiary, indexed for inflation.
But are there income limits?
Yes, restrictions based on the parent's income if the beneficiary is presumably a minor or dependent. Contributions wouldn't be allowed if the parent's adjusted gross income exceeds $400,000 for joint filers or $200,000 for single filers.
Okay, income tested on the parent side. What can you use the money for? Qualified distributions.
Three main categories are listed: qualified higher education expenses, startup capital for a qualified small business, and funds towards the purchase of a principal residence for a first-time homebuyer.
So, education, entrepreneurship, home ownership. What if you take money out for other reasons?
There's a potential penalty. Distributions taken before the beneficiary turns 30 that aren't for one of those qualified purposes could face an additional 10% tax.
An early withdrawal penalty, essentially.
Seems like it. The proposal also mentions rules for rollovers, reporting duties for the account trustees, and even a provision where the Treasury Secretary could automatically set up an account for eligible individuals if they don't have one.
Automatically set up. Interesting. Okay, a unique savings vehicle proposal there. Let's switch to healthcare. Health reimbursement arrangements, HRAs, integrated with the individual market.
Right. This proposes rules for something called custom health option and individual care expense arrangements. Let's call them choice arrangements for short.
Okay, choice arrangements, what do they do?
They'd essentially allow employers to offer HRAs, health reimbursement arrangements, that employees could then use to purchase their own health insurance coverage on the individual market, like through the ACA exchanges.
So instead of offering a group plan, the employer gives tax-advantaged money for the employee to buy their own plan.
That's the basic idea. These choice HRAs would have specific requirements, like non-discrimination rules to ensure fair access for different classes of employees, plus rule about substantiating expenses and providing clear notices to employees about their options.
Giving employees more choice, funded by the employer. How does this link to cafeteria plans?
There's a related proposal to create an exception allowing employees participating in these choice HRAs to pay their share of the premiums for exchange-purchased insurance using pre-tax dollars through their employer's cafeteria plan.
Making it easier to use pre-tax money for those individual plans bought with HRA funds.
Exactly, trying to streamline it.
Is there any incentive for employers, especially smaller ones, to offer these choice arrangements?
Yes, a new tax credit is proposed. Eligible small employers, basically those not large enough to be subject to the ACA employer mandate, could get a credit.
How much?
The proposal is $100 per employee enrolled in the Choice HRA for the first year the employer offers it, and then $50 per enrolled employee in subsequent years.
A little nudge for small businesses to adopt this model. Okay, lastly, under healthcare, changes to health savings accounts, HSAs.
Two main things here. First, a new category of qualified medical expenses, qualified sports and fitness expenses.
Using HSA money for gym memberships.
Potentially, yes. Or fitness classes, sports league fees, things like that. There would be an annual cap, $500 for self-only coverage, $1,000 for family coverage,
Right.
and also monthly limits.
Limits apply.
And the activity has to be ongoing, like a membership, longer than 1 day or multiple sessions of instruction, not just a one-off event.
Okay, encouraging sustained fitness activities. What's the second HSA change?
This one's a bit technical. It deals with situations where someone takes money out of their HSA for an expense they thought was qualified, but turns out it wasn't.
Right, that can cause issues.
The proposal would allow an individual who has an HSA-compatible high-deductible health plan, HDHP, to also have coverage under a health FSA or HRA for the rest of the plan year after they take such a non-qualified HSA distribution, potentially to help cover that expense without penalty.
So it gives them some flexibility to use other account types if they make a mistake with the HSA withdrawal.
It seems designed to provide a sort of safety net or coordination mechanism in those specific circumstances. Lessens the penalty risk, perhaps.
Could be helpful for avoiding unexpected tax hits. Okay, we've covered a ton already. Individual relief, business changes, OZs, healthcare. We still need to tackle proposals affecting tax-exempt organizations and a final bucket of other provisions.
Agreed. That first half was packed. The tax-exempt world and the other provisions section often have quite specific, sometimes complex changes that definitely deserve a closer look.
Absolutely. Let's take a quick pause here. When we come back, we'll dive into those proposed changes for nonprofits, universities, foundations, and then wrap up with everything else, from the debt limit to promoter penalties to cybersecurity. Stay with us.